eye-opening about monetary policy. So monetary policy have been a highlight in the newspapers nowadays whenever it comes to inflation. So what is a monetary policy? Monetary policy is the tool which we use to steer the economy for achieving the stability and the economic growth. So monetary policy have been very useful whenever it comes to bringing changes in the prices, changes in inflation, or we can say also it helps us to bring the stability. So what all we are going to learn in this video, we will be talking about the monetary policy in detail. Then we will talk about the objectives and framework of monetary policy, and then towards the inflation targeting, a primary tool, a major tool on which we focus when we talk about monetary policy. So what is a monetary policy? Monetary policy is basically a set of tools under which we have different components which we use, which we implement to achieve some of the desired goal in our economy. So whenever it comes to inflation, we always look upon to monetary policy. Why? So what happens is, it is believed that monetary policy can bring changes in prices in the short run as well as in the long run. So when we implement a set of tools to curb the prices, to bring the stability in the prices, and also to bring economic growth, that is the monetary policy. So it refers to strategies, actions, tools used by any central bank of the economy to regulate and control the money supply, interest rate, and credit availability in the economy. So monetary policy is a tool used by central bank of any economy. So who is the Central Bank of India? That's RBI, Reserve Bank of India. So any tools implemented by them, any strategies brought by them to bring changes into the monetary situation of the economy is the monetary policy. Now, monetary policy is very important, as I mentioned, for maintaining stability. Why? We will learn that. So crucial for economic stability, and Reserve Bank of India is the central bank of which basically just handles the implementation of monetary policy in India. Now, how does a monetary policy is used? Like, how do we basically implement monetary policy? Does RBI comes and says inflation come karo? No, of course not, right? So there are some tools which we use under the monetary policy. So the primary tool is the changes in interest rate. So RBI bring changes in interest rate so that the monetary base of the economy can change accordingly, and they can just, achieve whatever they are desiring for. So if they want to curb the inflation, if they want to bring the prices down, they would always like to decrease the monetary base of the economy, which can be done by increasing the interest rates of lending. So interest rate is one of the primary tool which we use to achieve the goals of monetary policy. Another tool is the money supply. So RBI can influence the money supply directly as well. Now let's see what are the objectives and framework. So when we talk about objectives of monetary policy, the question is, why do we need monetary policy? So if you can answer this question, you will be very much clear about the objectives. Now, I asked you one very simple question. When you go to market and you have a demand, you want to purchase something, what is the first question or what is the first thing which comes to your mind? What comes to your mind when you have to make a decision that whether do you need it or not? Answer this question in the comment box below, and we will learn that why, or what is the why basically the monetary policy is so much important in any economy. So the first objective of monetary policy is price stability. So price stability mein what happens is, when we used to talk about classical theory. So classical theory mein there is quantity theory of money, which says MV is equal to PT. T and V are constant here. So any change in monetary policy or money supply will affect the prices only. So if you double money supply, the prices will also get double. So according to classical economists, the monetary policy is of no use for economic growth. It is just for change in whatever changes you will bring in monetary policy, the same kind of changes will come into the prices. So if you want to bring down the prices, you need to you need to implement the contractionary monetary policy. So monetary policy is of two types: expansionary monetary policy, which basically increases the monetary base, and then on the other hand, we have contractionary monetary policy, which decreases the money supply base. So in controlling prices, we use contractionary method. So when you keep your money supply monetary policy is quite stable, the prices in the economy also remains stable. The second point is economic growth. So as I mentioned, that economic growth for monetary policy also ensure, but how? So when money supply increases, aggregate demand increases. Now this increased aggregate demand will put a pressure on supply. So aggregate supply will increase. The increase in the output production of the economy is what we call as growth. So if we have to measure the growth, we always measure the growth in the output. That is one of the way. So that is how it also ensures the economic growth. Then financial stability. So there is RBI into the monetary policy. So if there are coming any fluctuations, we know RBI can handle all of that. That is why everyone has a trust in the financial system of the economy. So it also helps us to maintain that. Now, how is the policy framework, monetary policy framework in India? So in India, we have the concept of flexible inflation targeting. So flexible inflation targeting mein what we do is we do not work on rigid inflation targets, that even if our inflation moves up or below by point percentages, then the targeted one, we will implement monetary policy. No, we will bring in the monetary policy if and only if the inflation goes out of the prescribed window. So there is a window of 4% minus 2 and 4% plus 2. So if your inflation goes beyond these two intervals, that's the time when monetary policy is implemented. Because as soon as if your inflation goes up by 0.1, 0.2, 0.5%, you just cannot ask RBI to launch the monetary policy, because doing that will bring the hurdles for economic growth as well. As we have just seen that if you want the stability in economy, you need monetary policy to be stable. So there comes a point only after which you start using the monetary policy only if and only if the situation of the inflation is going out of control. So that is the concept of flexible inflation targeting. Now this framework aims to achieve a specific target for inflation while also considering the need to support economic growth. So what basically happens is, as I mentioned, that there is a trade-off which happens between inflation and economic growth. So we just cannot accept one while trading off for the other. So that is why monetary policy is again important. Now, consumer price index, that is the primary indicator for measuring inflation. So how do we measure inflation in India? That is measured using CPI, consumer price index. This window which we are deciding, it depends upon various factors like the economic factors of the economy, the growth prospects, what the country is planning to do in the coming near future. RBI, Reserve Bank of India, is responsible for implementing this framework to ensure price stability and promote economic growth. Now, what is inflation targeting? So, inflation targeting is basically one of the strategies run under the monetary policy to target inflation. Now, if you are targeting inflation, if you want the inflation to be under control, we have mentioned that we are going to use monetary policy. So, the monetary policy, when it will target the inflation using some of the tools, that is inflation targeting. It is also done by RBI. It is done to maintain the price stability by setting a specific target for inflation. And we use several tools to achieve it. So RBI has introduced this inflation targeting so that we can maintain price stability also, and we also do not have to compromise on the economic growth. Under the inflation targeting, the interest rate changes are brought so that you can just change the monetary base. Now, how does changes in interest rate can actually help us in expansionary monetary policy or contractionary monetary policy is something you will learn in the part 2 of this video. So there is a part 2 of this video as well. So if you want to know this thing in detail, that how changes in interest rate can change the monetary policy, can change the situation of the economy, then please you watch the part 2 of this video. So I hope in this part 1 of the video you have learned some insightful things about monetary policy. I will see you all in the part 2 for the same video. Thank you everyone for watching.